Hi, Neil back again, and we're looking at the second part two of emissions, because last week we looked at carbon emissions, a carbon tax and emissions trading scheme. Now we want to look at how do we actually measure and report emissions if that is going to be the requirement of future stock exchanges, requirements, standards, and so forth. And what we are going to learn in this session is all about what are the requirements worldwide in Europe and USA, and what do they require vis-a-vis exactly how companies need to disclose their emissions. So it's not about taxes or emissions trading scheme. We're talking about the actual report, the measurement and the reporting of emissions by companies worldwide. All right, so we need to start with the big why. Why are we covering this? For the exact reason, the example I've got here, the US Securities and Exchange Commission proposed rules to enhance and standardize climate-related disclosures for investors. And this was in 2022. Wow. All right, less than a year ago. And it requires disclosures of scope 1, we're going to talk about that, scope 3 and 2 emissions, and the gradual implementation disclosure of scope 3 emissions. Now I'm in front of it a bit here, but I just want to show you for now that scope 1 and scope 2 are easy to measure and disclose. The tricky part are scope 3 emissions, as you'll learn in this session. And so this standard, when it comes into being, will apply first and foremost to the largest companies. And there'll be a gradual implementation for smaller companies over the coming years. And that's basically what this is saying behind us. And really, it brings the SEC, the US stock market and their requirements in line with the task force of climate-related financial disclosure and the greenhouse gas protocol, which is coming out of Europe. All right. So that's why you've got regulators now saying you have to disclose. It's not a voluntary. It is no longer optional. You must do this. Otherwise, you're out of here. All right. So let's learn more about what do we mean by scope 1, scope 2, and scope 3 emissions. All right. Now, I've got 3 words to describe it, and I learned this from a webinar. Scope 1 is all about burning, what the company directly burns in emissions itself. Scope 2 is when they buy emissions, not they buy the emissions, but in the process of buying electricity or gas from these other emitters, they're actually purchasing emissions. And scope 3 is beyond, in other words, downstream and upstream. So this is basically the difference between scope 1, scope 2, and scope 3. And what you'll notice from the diagram above, scope 1 is like company facilities. If they own a fleet of vehicles, then it's the emissions of those vehicles. Whereas scope 2 is all about when they purchase electricity, when they purchase heating and cooling, and when they purchase steam, for example. And therefore, they've got to report the emissions of the entity that sold them the electricity, that sold them the heating and cooling, that sold them the steam or other types of energy. And scope 3 is basically everything else. So you can imagine that scope 1 is very easy, very transactional, because the company knows what it is doing and what it has control over. Scope 2, very transactional as well, because they know what they have purchased. The accounting system is going to tell you that. You just need to get more detail about the scientific basis for, well, how many kilowatts did you use of electricity? You go and figure out from science-based data records to say if you burn a kilowatt of electricity, you purchased it and used it, then this is how much on average of CO2 you have emitted into the environment. So scope 2 is pretty easy as well. But scope 3 is much more difficult because, number one, for the most part, it represents 60, 70, 80% of the emissions by the average listed company. And number two, it represents dozens, scores, hundreds, or even in some cases, thousands of other entities' emissions that a company is trying to collect, measure, aggregate, and then report. Oh, wow, you thought financial accounting was hard enough. Once we get into scope 3 emissions reporting, you have not seen anything yet. Okay, a little bit more detail on each. All right, scope 1, and I'm actually got a excerpt from the greenhouse gas protocol. And this download of this document tells companies how they should disclose, how they should measure, and how they should report their scope 1 emissions. And basically they are direct emissions from owner and controlled sources. For example, the combustion of fossil fuels in owned facilities, company-owned vehicles, and emissions from industrial processes. All right. And so scope 1 emissions report may include the following information: the total emissions from each source, the quantity of fuel consumed and energy used, the calculation methodologies used, emission factors applied, historical data and trends, and measures taken to reduce emissions. Pretty straightforward, and companies are doing that today and reporting this as we speak. Let's get the scope 2 now, shall we? Again, now I've downloaded this from the greenhouse gas protocol, and this is a whole booklet on scope 2 guidance. And basically the definition of scope 2 emissions are indirect emissions from the generation of purchased electricity, heat, or steam. The examples: electricity purchased from a utility company, heating or cooling purchased from a third party. So we're emphasizing that scope 2 emissions are associated with the consumption of energy and are influenced by the energy mix used by suppliers. And so when you're reporting, you want to report the total electricity consumption, emissions associated with purchased electricity, calculation methodologies used, emission factors applied, and the breakdown of emissions by location or energy source. Again, you probably need to refer to the science-based targets to do these proper calculations. They require knowledge of engineering, rather than chemical engineering, rather than knowledge of accounting to undertake proper calculation and disclosure in this area. So 1 and 2, pretty straightforward, science-based. Step 1, step 2, step 3, very analytical, very mechanical, and requiring some engineering knowledge in order to understand the analytics of the science behind how much emission is at 1 kilowatt hour worth in a particular location, country, etc. Wow. All right, now we go to scope 3. This is the hard one. Again, I've downloaded an excerpt from the scope 3 calculation guidance from the greenhouse gas protocol again, and that document is accessible in your learning platform, and also you can download this from the internet. Now, scope 3 emissions are all other indirect emissions that occur in the value chain of the reporting company. Examples: supply chain activities, business travel, employee commuting, and product transportation. We need to mention that Scope 3 emissions are often the most challenging to measure and control due to the complex nature of the value chain. As I said earlier, your value chain, the average firm's value chain, could consist of dozens, scores, hundreds, thousands of other entities, service providers, suppliers. And that just makes the whole calculation, the aggregation, so much more complex. Again, you now need to provide data on who are all your suppliers, who are your customers, or all other relevant stakeholders. And then not on top of that, only on top of that, you have to talk about strategies to reduce emissions or to engage stakeholders. And so part of your report that you have to provide in this unit is to actually look at initiatives that are being reported by companies under this Scope 3 banner, because it's the most difficult of disclosures to actually report on and deal with. All right, so what are the reporting frameworks? Well, a common one is the Carbon Disclosure Project, which follows the Greenhouse Gas Protocol. But this is more like a ranking project where they invite thousands of companies around the world every year to fill in a questionnaire. Why would they do that? They'll do it in the following. It's voluntary, and they ask questions about climate change, forest protection, and water use. And then the CDP scores the companies on a scale of A to F on their low impact operations, ongoing improvement, and transparent disclosure. Why would they do that? Well, this is a way for companies to actually say how well they are doing in their global footprint. And they can sell, if they get an A ranking, they can sell that to their stakeholders. They can tell their customers, they can tell their employees. It can be part of their company culture, part of their strategic vision to create this mindset, this culture that we care about our carbon footprint. So there are definite motivations for companies to voluntarily provide this information in order to get a high ranking. And yes, you know, rankings are rankings, and we're trusting that what they report is true and fair. But over time, the devil's in the detail, and companies that report falsely will be found out over time, year after year after year. And also, the big benefit, remember, is to help the own company culture, internally help employee value proposition, externally you can sell to your customer, you can sell to other stakeholders, maybe you can get a lower cost of lending, etc. There's a lot of benefits for getting involved in this ranking process. So here's an example of the ranking in 2022, and notice that you have a lot of European companies ranked, but the highest company that is US owned that is ranked is HP, coming in at number 4. And if we go down, 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 you've got L'Oreal, and that's a European company. Down, 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 you've got Philip Morris, another US company, and you're probably thinking, Philip Morris International? They make cigarettes. How come they can be ranked like that? Well, obviously, they're ranking on climate, forest, and water security, not necessarily on their product. And then you go down, 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 there's Accenture, one of the largest consulting companies in the world, being ranked in the top 20 on the CDP A list in 2022. And then there's further rankings as we go on and on and on. And you've just got hundreds and hundreds of companies being ranked every year on the CDP A list. Wow, this is so cool. All right. Now, that's an obvious benefit of having really good scope 1, 2, and 3 reporting, because it enables you to improve your operations so that you can enhance your ranking on that list, which improves your product sales, improves your marketing, improves your stakeholder engagement, improves your employee value proposition. These are all good things, right? Okay, are there any other benefits? Well, basically what I've just said is listed here. Enhanced environmental performance monitoring. So that it helps in disclosures, especially in the future when you have to comply, as I just said right at the outset. The SEC is going to require compliance, not voluntary disclosure of scope 1, 2, and 3. And that is coming in years to come for all companies, the largest companies in the coming year. Identifying emissions reduction opportunities, demonstrating commitment to sustainability and stakeholders. I mentioned that. Improving supply chain transparency. Yes, that's increasingly being recognized and required by various stakeholders. And encouraging innovation and efficiency improvements. That's in the coming weeks where we talk about beyond rhetoric. So I'm really glad that that's coming on our radar now. These are all benefits from scope 1, 2, and 3 reporting. Look, Neil, what are we talking about here? What we're really talking about is better measurement of what a company is doing. Because for hundreds of years, and especially since the 1930s, when the profit and loss, balance sheet, cash flow statements become required financial disclosure and required auditing, up until recently, companies really haven't had the motivation to actually measure more broadly and go beyond the typical transactional approach of financial accounting. All right. And what you'll find is that all of these requirements, the requirements in earlier week modules that we talked about, all of them just require companies to start measuring beyond the ordinary transactions they enter into day by day, week by week, month by month, year by year. They require you to measure more things. They require and in the process of measuring more things, the company learns more about itself, about how it can better create value, how it can become more efficient. Wow. You're like, don't they say that when they ask you to disclose? No. All right. When different reporting bodies ask you to disclose, they say you need to disclose. They don't say because it's for your own good. But really, seriously, it is for your own good. And that's an exciting thing. And I'm excited about that because I'm really gung-ho on management accounting, less so financial accounting. And management accounting is all about measurement for your own value creation. All right. Let's get to the end of this before I get too carried away. All right. Now, what's the sense of emissions worldwide? Well, remember in last week when we talked about carbon tax and we talked about emissions trading, remember I told you that Australia on average emitted as a country, remember it's number 3 in terms of emissions per capita, next to China, next to USA. Was it 2 or 3? It's up there in the top 3 per capita. But remember, its population is only 23 million compared to China's 1.4, 1.5. So obviously its total emissions are less. Australia's total emissions is about 500 million tons. Okay. All right. Have a look at the graph at top. The total emissions worldwide, global, is 40 gigatons. So what does that mean? Like Australia is basically half a gigaton. All right. The total in the world is basically 80 times the emissions by Australia. Are you with me here? All right. So let's have a look at those different colors. China represents about 1/3. All right. India in total represents maybe about 1/10. United States represents about 20%. The EU about 1/10. So basically that's 30% plus 20, that's 50, plus 10, that's 60, plus 70. That leaves another 30% less, probably as I look here, 15 out of 40, we're talking about 35% left for the rest of the world. All right. So you really need to get a sense of how gargantuous this emissions challenge is. All right. And when we say Australia emits the highest per capita, well, it's only really half a gigaton, whereas the total in the world is 80 gigatons. All right. So we can say, well, Australia doesn't emit very much, but because it only has 23 million people, it is the third largest or second largest per capita emitter in the world. All right. So, I just want to give you a sense of what we're talking about here, the gravity of the problem. Notice the challenges and limitations of scope 1, 2, and 3 reporting. That is, gathering accurate data from various sources, ensuring consistency and comparability across different organizations, addressing data gaps and limitations in the value chain, and dealing with different reporting boundaries and scopes for different industries. All right. So these are the challenges. It's really in the measurement. It's really the collecting of the data. All right. And scope 3 just requires a lot of seeking out and searching across hundreds, if not thousands, different entities, whereas scope 1 and scope 2, scope 1, it's your own entity. So that's one. Scope 2, maybe it's only a dozen at the most, even less in most cases. All right. But scope 3, like hundreds, thousands. Wow. It's just ginormous, the data problem, the measurement problem, the collection problem, the aggregation problem. All right. Now let's have a look at the best practices. All right. This is not all doom and gloom because we can learn from best practices, can't we? Yes, we can. Number 1, setting clear goals and targets for emissions reduction. Engaging the stakeholders. Okay, you may have 100 stakeholders, but figure out who are your dominant stakeholders. Who are your top 20 suppliers rather than looking at all 100 suppliers, your top 20 suppliers that contribute to 80% of the emissions of all of your suppliers. So you follow a Pareto optimal rule, like an 80-20 rule. All right. Regularly monitoring and verifying data accuracy can help. So more regular monitoring and continuously improving data collection and reporting systems. So the most part, companies are putting in place sustainability teams. They are putting in this emissions measurement and compliance teams. And by the way, it is not your accounting team that may be the most expert in this area. It's likely these teams have chemical engineering background. They have electrical engineering background. They have engineering backgrounds because they then have a better understanding of the science-based targets that are required to convert, say, different activities into CO2 emissions. All right. And so 1, 2, and 3 here is we determine the scope 3 categories. We estimate the GHG emissions and we improve and expand our emissions and estimate over time. So I just want to reiterate the importance of scope 1, 2, and 3 in achieving the sustainability goals that we started this course on. But I think the big benefit is it can contribute more to the value creation in the organization. And that is where we're going, because I want to leave you on a positive note. And that is the following. That is, yes, we iterate the importance of scope 1, 2, and 3. Yes, scope 3 has a myriad of challenges for companies to face. And most of them will not be able to properly measure scope 3 challenges on the first go. And it's going to be a learning process. And for the most part, it's going to be an exploratory process. And it may take several years for companies to get into the routines of working with their supply chain, of working with their downstream suppliers, so they can automate and probably bring in technology to better collect and aggregate their emissions associated with scope 3 emissions. But here is where we are in this unit. We started off with sustainability disclosures way over there. Great. Nice to do. We appease the stakeholders. We are a responsible company. Here is our profit and loss and balance sheet. Here is our sustainability report. Give us cheaper loans. Employees, stay with us because we're thinking about our carbon footprint. Stakeholders, love us more. Give us more money. Investors, invest more with us. Let our stock price go up because we are a sustainable company. Well, that is well and good, but there's a lot of greenwashing going on there. That is, we can make up our disclosures. And yeah, we can get them accredited by a third-party auditor like an accounting firm or an engineering firm. Yes, but there's still a bit of greenwashing going on. It's not like a strict auditing standard where auditors have to give a true and fair view of the profit and loss, the balance sheet, and what's the other cash flow statement, and have that signed off as per Sarbanes-Oxley by the CFO, the CEO, and like they're legally liable if they report the wrong thing. That we're not there yet with sustainability reporting. All right. So there's a lot of made up stuff. There's a lot of greenwashing going on. All right. Now we get to emissions reporting, which is the next more stringent approach to measurement, because we're now using science-based measures and targets to figure out how much is the firm's carbon footprint. It's a practical measurement approach based on science-based targets and methods. So it requires a little bit more investment by organizations in measuring their carbon footprint, because they have to measure and report their carbon emissions. And it's not about, having a lovely disclosure statement. It's all about having the most correct and most accurate estimate of what is their carbon footprint. And this forces a big change. For the most part in the last 2 decades, there's a lot of greenwashing going on because of the need for just sustainability disclosures. But now with emissions reporting, that is putting an end to this greenwashing, because you now have to evidence your measurement with science-based approaches. All right. And it's easier to audit. It's easier to check whether you are stating correct emissions or not. All right, great. All right. So where does that lead us to? Are we still just being dragged into this pen and we don't want to go into? Well, yes and no. We're being dragged there by compliance requirements like the SEC at the outset of this module. But now I'm saying that there's a huge value concept that we can contribute to of firm value by doing all this measurement and creating more visibility and transparency. And that's what we've got here. In the process of actually forcing companies going through this practical measurement of their scope 1, scope 2, and scope 3 emissions, setting out their initiatives with their suppliers and how they're improving their supply chain, in a sense, they are improving their opportunity to have visibility of their strategy. And in that same case, they can improve their vision, their strategy, because they've got more visibility and transparency through better measurement. And that's what we've got here. And when we have more visibility and transparency through better measurement, guess what? We can actually have a better feedback mechanism for whether we are implementing our strategy Are we off our vision? Are we on our vision? Are we meeting our strategic goals or not? And because we are getting visibility and transparency through better measurement being more frequent measurement, maybe every week, every month, not waiting for every quarter or every 6 months. So therefore, we can see whether our strategy is on track or off track every week or every month. So with better measurement becomes better visibility, better transparency, and that only can help firm strategy. And as we look into firm strategy next week and the module thereafter, you'll get to see that this is a positive thing. And this is what I believe should be driving companies' approaches to emissions reporting and sustainability disclosures, because in the end, it improves their strategic vision, it improves their strategy for their sense of being, then that improves employee value proposition, that improves the products that are being made, it improves the whole supply chain management, it improves downstream management, and the totality of the firm value creation from upstream to the firm to downstream improves. And then that can only be a good thing for improving firm value. And that's the big motivator that excites me for where we are going now that the Scope 1, Scope 2, and Scope 3 emission requirements are now on the table for most large companies around the world. So that's the module on Scope 1, 2, 3 reporting. Look forward to seeing you into the next module where we look at the management accounting, the value creation, the beyond rhetoric of sustainability. See you in the next module, and thank you for listening. Bye for now.